Welcome back. Well, last aspect we were focusing on was determining the country of corporate residence, and it's quite an important topic because sometimes, depending on the rules and regulations of each country, you might find yourself resident in more than one country, and you might end up paying taxes more than once, which is a very, very clear disadvantage to the company. So trying to avoid this, we've got OECD rules which specifically tell us the best method of deciding on the country of corporate residence is the place of effective management control. So if you stick by that particular condition, very unlikely that you're going to see yourself paying taxes in more than one particular country. Now, once we've decided on the country of effective country of corporate residence, we then go ahead and look at what tax rules apply to us. Another very important term which we tend to come across is competent jurisdiction. Okay, it's simply an area where tax rules apply, sometimes referred to as a country where tax rules apply. But if you look at different countries, there are some countries where they've got different tax rules for each state. So let's just call it an area where tax rules apply. That's a competent jurisdiction. And this again is quite important because depending on payments being made between these different tax jurisdictions, we might have additional taxes payable and additional tax rules. Well, when payments are made across different tax jurisdictions, we've also got a different tax, something which we call a withholding tax, WHT. Withholding taxes are generally deducted on payments such as interest, dividends, royalty payments, which are made between countries. So if a dividend is paid from country A to country B, chances are the tax authority in country A deducts a withholding tax prior to remitting the payment over to country B. Okay, so again, quite important when we look at payment of taxes. Since most companies do not want to pay taxes in two countries, and since it's unfair that the companies end up paying taxes more than once, governments of different countries have actually signed up tax treaties, which ensures that the company only ends up paying taxes once or suffers the higher of the two tax rates. Now, this involves a larger area, something which we call double tax relief, but we just need to focus on the basics of it. So let's quickly just go to a small example which would hopefully clear things out on exactly what you'd be examined on. Just focusing on our slide, this is on withholding tax and double tax relief. Company X, which is in a different country, invests in company Y, which is in a different country, and X has bought over 40% of Y. And you've also been given a few details right at the bottom. Company Y, profit before tax is 900,000, taxation 300,000, profit after tax is 600,000. And out of the profit after tax of 600,000, you'll see a dividend is declared for 500,000 by company Y. X's share out of the 500,000 dividend should be 40% because X has invested 40% in Y. 500,000 multiplied by the 40% should give us $200,000, which X is entitled to. That is X's share of the dividend declared by Y, which is also referred to as a gross dividend. But before the payment is remitted over to X, withholding tax of 10% will be deducted by Y as per the rules in Y's country, which would amount to 200,000 multiplied by 10%, which is 20,000, and the remaining 180,000 sent over to X. Effectively, X only receives 180,000, which is 90% of the gross dividend, and we refer to this as a net dividend. So notice X has already paid a tax of 20,000 on this dividend, which it is entitled to deduct in the event X is required to pay taxes in its home country. Right? Now, in addition to this, since X owns a significant percentage of Y, which is 40%, there is an additional tax figure which could be used for double tax relief purposes. This is referred to as an underlying tax. And what we are trying to do here is calculate how much taxes Y has paid on behalf of X before declaring the dividend. So Y has already paid a corporation tax or an income tax of 300,000. This is on behalf of its after-tax profits of 600,000. So how much of this 300,000 tax is entitled to the 200,000 dividend share that X receives? That's precisely what we're going to look at as an underlying tax. And the formula for an underlying tax is a gross dividend divided by profit after tax. The key there is profit after tax multiplied by a foreign tax paid. So we've actually got a gross dividend which X is entitled to of 200,000. If I just go back to the previous one, you'll see that X is entitled to a gross dividend of 200,000 there, which is then split by the profit after tax. Profit after tax of company Y is 600,000. So gross dividend of 200 divided by the 600,000 worth of profit after tax, and then multiplied by the foreign tax paid. This is a tax which has already been paid by company Y. You've got 300,000 there, and this basically indicates that company Y has already paid $100,000 worth of taxes on behalf of X's dividend. This can then be used in terms of double tax relief. Now, important aspect of taxation, it seems to be quite frequently tested, and common complaint by the examiners is again quite badly answered. So suggestion would just be to focus on this aspect a little. In addition to this, if we just focus on a couple of other smaller points on taxation, we've got a little bit of theory which involves a few terms, things like hypothecated taxes, you've got effective incidence, you've also got things like direct, indirect taxes, a tax gap, all of which are very, very small areas of theory, but could gain you a couple of easy marks. So another very frequently tested topic is on tax avoidance and tax evasion. Few areas you should probably brush up on. I've just run you by a couple of the more difficult areas or a couple of the more problematic areas, but these are bits of theory which you should definitely go by, because you will definitely receive 25 marks worth of questions there. So key aspects to remember out of what we've actually gone through today: ensure that you've got a proper layout to your answers at the exam, ensure all workings are shown, mark out your final answer so that the marker does not have to go looking for your final answer, read the questions carefully so that you answer a question the examiner has asked you on the date of the exam rather than a question you've got in mind. Give emphasis to the verbs that are being tested. That is really what's going to tell you how much to write as far as your exams are concerned, right? So few important aspects that we've come across today, and what we can focus on the next time around will be on a few standards, specifically looking at IAS 16, 38 and IAS 32, right? Thank you very much.